All right. Good morning, everybody. Welcome back. It kind of feels like a Friday, huh? I think we made it. We're going to get inflation data this morning. It's very likely the biggest thing on the table. The construction spending later in the morning very likely isn't going to be such a big deal. European central bank speakers chipping their teeth. This is going to probably not an issue. The rig count, those rig counts don't change much. I spent most of my life working on those rigs, and that number really shouldn't fluctuate, so we're not expecting anything out of that. And the rest of this stuff will happen after the market closes, so we'll already be digging into the pizza and Pepsi at that point. So we really just got to get through the PPI. It's a look at how we've started the year, right? Get some inflation perspective. And the narrative really isn't shifting around in that area that much, right? We've already got the higher for longer story looking at the rates. The market has continued to gyrate within this range. So let's take a look at what's going on around the world. Small caps are down almost 1% this morning. Then we have the Dow, the Nasdaq, and the S&P down the least of the group at about 0.5%. China's flat. Japan around 0.25%. Then the UK up 0.5%. Keep your eye on Europe today. When the Europe market closes, that might help us out a little bit. We've been sitting in this range. This is SPY on a weekly, and this range just continues and continues and continues. But at some point, we've got to get out of the box, right? Uh, it never hurts to put on a trade if you've got control of the risk, right? So um, you wouldn't want an entire portfolio full of lottos. At least I don't. I don't like having a whole portfolio of them. But when you can shop around and find low risk entries or just cheap lotto trades to put on, especially in front of you know bricks that are coming into the wall of worry, then why not, right? That's the whole point of really cheap trades or just low risk opportunities. If you've gone into any of the options material over the years, one of the themes that gets promoted a lot is when options are cheap, you just, pick them up. Not because there's any sort of technical analysis that suggests price is going to go up or down or do anything in particular, just that when they're cheap, you buy them. When they're expensive, you sell them. So, poke around throughout the day today. Take advantage of the fact that it's Friday. Um, Target the March OPEX because it's very likely that when we get out of OPEX, we get on the other side of it. If we haven't expanded yet by then, we very likely will on the other side of OPEX. So you could target OPEX, which is options expiration. It's the third Friday of the month. It is always the third Friday of the month. And pick your direction. I don't think it really matters. Um, the price of the option would give you your direction, right? If calls are cheaper than puts, then buy those. If puts are cheaper than calls, then buy those. The idea is that it is a low probability trade, so you don't want to put a lot of money into it, right? If there was conviction or higher probability, then that would be something completely different, right? So 8:30 PPI, then 10 o'clock construction, and that's pretty much the end of it. No auctions this afternoon to deal with. Now, for that discussion of getting out of the box and making a move in one direction or another, 6,800, this is very large level down here, and 7,000 here, right? That's a 200-point range from 68 to 7,000. And there are some speed bumps along the way, areas that we can get kind of hung up. But those two dominant structures are what is in our way. And it's very possible that we just stay within those until the March OPEX is done, right? But if we do get on the other side of 7,000, we still got these other levels. And underneath the 6,800, then we've got these other levels. So, we're not headed to the moon and we're not going to just completely crash and burn. But something has to shift, something has to give if we're going to finally get out of this range. And the longer we're here, the more we build structure around the location, which is one of the reasons we need OPEX. The options expiration can remove those structures. Think of going bowling with the kids and they put those bumpers in on the sides so that the ball has to go down the lane without falling in the gutter. We got to get those gutter guards out of the way. CTA positioning, they're still negative, but they're still just slowly unwinding. We're not seeing, a swift unwind here, which is fine. That's what we would want to see, right? No panic, no chaos. And if I was to zoom in, it is starting to flatten out just a tiny bit, right? It's not even significant at this point. And if we look at CTA position change, there's really nothing here, right? I think this really highlights what we want to focus on. If they were making significant choices and significant changes, then we would need to be more focused on it, but they're not doing that. They're in wait mode as much as we are. So, don't fight the crowd. All right, we have a high risk score coming out of the White House today, but it looks to be after the market closes, so 435. Maybe it causes something earlier, but probably not, right? So there is White House risk today. We're just dodging the impact because it'll be after market close. With the markets down this morning, take a look at the individual names that are down and how many of those names are down. The S&P 100 stocks that are down at least a half of a percent, 35 out of 100. And the nice thing about using the S&P 100 or the NASDAQ 100 is because you can turn your answer into a percentage. So 35% of the S&P 100 is down at least a half of a percent. That's not as negative as looking at the Russell, the NASDAQ, Dow, and seeing how everything is down and it feels really negative. This doesn't feel all that negative. Then once we get that number and we start poking around at what names are down at least a half of a percent, we got a lot of finance names, major banks. We, of course, got some tech names and Mag 7 included, right? So we Meta, Amazon. Then we got some bigger financial names, Visa, Capital One, American Express. So it's spread out through a lot of the things that we would need if we were going to get a rally day. Chips are down, got a lot of chip names that are down at least a half of a percent or more. So finance, tech, consumer discretionary, those are our rally sectors. Without those, we don't have the market breadth for a rally. Doesn't mean we can't rally. We can still get something from the FX markets, or commodities could kick it off. Even just intraday, 0-day flows could do that. But looking at things in the pre-market, we look at those sectors every morning trying to spot if there's anything there that could really weigh us down and or break us out. And sure, they're down, but not enough yet to really be the threat that we want to focus on. Another way to see that is using heat maps. You know, when I was new to trading, I seen these heat maps and I thought, that is so stupid. Who even wasted their time building something like this? Like, who's going to use this? But I was new and I didn't realize how valuable these things are. And you can sit and squint at a watch list all day long if you want to. Your eyes are going to get sick of that really quick, especially when you do this year after year after year. If you want a quick glance and to see what's going on out there, get used to using a heat map. It's really helpful. The size of these boxes are based on market cap, so the Mag 7 stands out really easy. It's all the big boxes, right? The boxes stay gray unless the market has moved at least a half of a percent higher or lower. So Netflix is up because it finally bowed out. But the other names are red, and the color of that red shifts depending on how deeply negative they are. If they're down just a half of a percent, then it's this kind of red. But once they're down more than 1.5%, then it changes to this other kind of red, more like a pinkish color. So you get the idea, right? You can see a lot without squinting at the tiny little watch list, get a feel for what's going on out there. And I mean, this kind of tells the whole story, right? It's negative, but it's not a sea of pink. It's just a sea of red. Not that bad. We're looking to see this inflation data turn around a little bit, right? It kind of got elevated into the end of the year. We're going to be getting January's numbers, and I think the consensus is to turn away from this 0.7 and head back towards the 0.5. I put lipstick on a pig, so hopefully this will help the person that was asking questions the other day, trying to understand the higher high and the lower high that I was talking about, the higher lows. So right now we've got this question mark situation, 68.50. It is the angled trend line. It's also just the options level. And it is the reversal zone from this day and this day, right? It's the 23rd and the 24th. And if you count back, really, it was all of these wicks. So 1, 2, 3, 4, 5 days in a row where we tested that 68.50 and wasn't able to close below it and got back above it. It will begin to act a bit like a magnet if we get too close to it. The question becomes, well, how close do we have to get before it begins to be that magnet and draw us in? I'd say it starts with a breakdown of yesterday's low. We got to get outside of that box before we can do anything else. Then we'd focus on the 111 and the 1236 of yesterday. And then that gets us really close to 68.50. And at that point, we might as well just go on down there and get it. We are continuing to set new lows in the Globex. The range that we've got really isn't that bad. And there's a lot of defense around yesterday's low that we're going to examine within the volume profile and the TPO profiles. But for now, just focus on that 68.75 level. I want to get to that and then get to yesterday's low, see if we find any structure there, and then we'll focus on getting outside of it. We are underneath all of the major moving averages, right? We're done with all of that. So as I mentioned the other day, those moving averages are in no way some form of support or resistance. We don't look at them to provide anything like that. Overnight volume 85,000. The average that we're looking for is at least in the mid 50s. So we have, quote, above average participation in the overnight, which is good. They're not sitting out. That would have been a warning to us, right? If they were sitting out, then we would know that there's something of a threat that they're concerned with, maybe economic data or some earnings or headline release that they were concerned about, and they were sitting out waiting for that data to come in. They're not sitting out, so all good. Even though they're not sitting out, they are hedging this morning. Now, they're always hedged, right? It's important to understand that. They are always hedged. This is additional hedging. So think about having insurance on your house and you decide because you hear news that there's a hurricane coming to call your insurance company and get extra insurance on the house. Well, you can't have a house without insurance, right? So that you're just getting more insurance. And then once the threat of the hurricane is gone, maybe you cancel it because, extra insurance is just extra cost. And this is cost for them. They can't hedge in a way that like retail does, where we can turn it into a trade and do it risk free and really minimize the threat or the risk of the cost. They can't. They just got to eat it, which is like starting a fire and throwing money in it and watching it burn. They don't get their money back. So if they're willing to go in and add additional risk to spend that money, they think it's worth it. This isn't my opinion. I'm not guessing or assuming that they're hedging. I am telling you they are hedging this morning. So they're concerned about the PPI data that we're going to get. That I am making an assumption on. We don't know why they're hedging, but it would stand to reason that they're concerned about the inflation data that we're going to get at 8:30. If I'm wrong and it's not the inflation data, then this number won't begin to go down after 8:30's data comes out. It'll stay up, and then we'd have to focus on, well, what's the next time frame of data? And I believe it was 9:45 for the next data point. I think it was. And then of course we've got the construction spending after that, right? So Maybe it's not the inflation data at 8:30, but I think it is. So we do want to focus on that. Since there is a market maker move signal this morning, and that implies they're concerned with a big move, we want to consider what that big move would look like. Say a liquidity bar or a liquidity gap. Now, I've talked about this big bar before. The idea is at 8:30, we're likely to get a big candle print. Once that print comes in and that candle closes, we can evaluate how that candle was formed and then mark the candle out, measure it from its highest to its lowest point, mark the mid, and focus on getting the gap closed. This ought to do. So this is the kind of bar that I'm talking about. That was a CPI data print 8:30. It closed in the upper 25% of that bar. Now this one never closed the gap, right? But the idea was that we want to see price come back to where that candle opened. These kind of candles, I've called them liquidity gaps. It's not a gap in price, it's just a gap in flow, in orders on the dome, in the queue. So mark that bar out, measure 50% above and 100% above that bar, mark the midpoint of the bar, and the idea is we're looking for price to come back to where it started. Here's another example. Notice there's no wick in the opposite direction. That's kind of a big piece to what I'm looking for. So we want the data to come out and then for price to make a big move. It doesn't have to go up. It could go down. I'm not picky. I don't care what direction it goes. But we don't want a wick going in the other direction. And we want price to close in the last 25% of the bar, right? So we don't want it to close near the mid or back near where it started. Once the candle is formed, then you can mark out the levels. You can see how we reacted to the midpoint of that bar. It wasn't able to hold that, but it at least responded there. And we got the gap closed around 10:30 or 11 o'clock. We made it back to where that candle started. Here's another example going the other direction. No real wick going the wrong way. Closed in the lower 25% of that bar. Responded around the halfway point. Got the gap closed around 10:30, 11 o'clock. Same thing here. No real wick going in the wrong direction. Closed in the upper 25%. Now we paused within that wick structure before we continued on even further. Then we spread out, put in a little bit of topping pattern, worked our way down to get the gap closed between 10:30 and 11 o'clock. Kind of get the idea, right? It's going to take time. We're not looking to get this gap closed in 20 minutes, right? It's going to take time. And just like in that first example, it does not actually have to get the gap closed. More often than not, if we form the gap close setup, we're going to close the gap, but that doesn't mean we have to, right? So you can trade this if you want, but you can also just use it to identify some tradable ideas. Notice in all of those big green candles where we popped up at 8:30 that we didn't just keep running higher and higher and higher all day long. So at the bare minimum, if I can stop you from buying calls at 9:30 just because we had a big 8:30 green bar, then, cheers. This is what we don't want to see. 8:30 print comes in, we get big wicks on one side or both sides, price closing near where we started. There's not much gap to close if we close near where we opened, right? That kind of defeats the whole idea. But even if we do get this kind of bar, we can still measure 50% above that bar and 100% above that bar or below if we had gone lower. We can mark the midpoint of that bar, And that way, if price breaks the bar's range and runs higher, we'll see where the midpoint is because that's what we're going to expect to reject against, just like it did here. Another example of what we don't want: big wicks. Take that bar, measure it out, split the mid, measure 50% and 100% above and below. Another example of what we don't want. Kind of get the idea, right? I have found that showing both what a good one looks like and what bad ones look like, that people kind of get the idea, right? So we don't want this. It's a liquidity gap, right? We don't know for sure that we're going to get that, but with them hedging this morning, the possibility of a big move is possible. But on the other side of that, I can make the lawyer's argument that big moves happen when somebody is offsides and then they have to scramble to change their position, right? Say the news comes out, it's really positive and they're short, then they've got to scramble to get in there and buy back their shorts. While everybody is scrambling to buy, that forces the price to move really fast, and then we get some of those big bars. But if they're hedged to the hilt, then it doesn't matter. There's no such thing as offsides when you're hedged, because if it goes up, you're covered. If it goes down, you're covered. And then you don't need to scramble, and nobody goes in there chasing after the bid or the ask. So the lawyer's argument is we won't get one of those really big bars simply because there's no need for the big bar. We're already hedged enough that that they're not going to scramble. I'll still keep the argument that because we do see the market maker move, there is the threat of a big move this morning and that we could get one of those bars. Today's floor pivot is lower than yesterday's pivot. That's bearish. Price opened underneath it. That's also bearish. We've already hit it, so there's no draw to get us to go up. We hit it, tagged it, wasn't able to get through it. Now we've fallen back down below it. So it doesn't even owe us a daily pivot tag because we've already got that out of the way. We are falling down through the weekly pivot, but we're at that weekly pivot, and there's not a lot of structure opportunity if we're on it. What we would typically say is if we're below the weekly, we want to look at bearish scenarios, and if we're above it, we want to look for bullish scenarios, but we're at that pivot, so it's not really helpful, and it's Friday. One of the things that really makes the weekly pivot awesome is when you get too far away from it. The mean reversion capabilities are fantastic, but we don't have that. We're on the darn thing. So the weekly pivot, not helpful today, right? It's just absolutely not helpful at all. The S&R lines would have been more helpful, but they are a long ways off. So if we want the S&R lines, we got to go get it. And at this point, since they're so far away, I wouldn't focus on them. I would focus on the ADR lines: yesterday's high, yesterday's low, yesterday's mid, today's floor pivot. Those are the levels that I think have more value to us. The weekly channel might provide a little bit of a speed bump down here at 68.61, but that's one of the S levels. So, just use it as an and. It's about as much value as it likely provides. So the distribution that we built out this week kind of highlights the mood that we've been in now for a while, where we just get these groups and these clusters. And I highlight that it might seem normal for newer traders, but a lot of times we get a market that just makes good, clean, trending moves. And then we get long, stretched out profiles that it has a more even distribution to it. And instead, we're hitting a zone and we're staying parked there for a while. Then we hit another zone and we stay there for a while. We're just not getting anywhere, right? Now we're retracing the previous zones. So we're cutting through the point of control. We're hanging out in that distribution at the moment. Once we begin to expand outside of that, it's going to get thin, so we could pick up a little bit of speed. And then we got a speed bump around that 6850 area. Underneath 6850, we're going to target the next 50 at 6750 with a little pause maybe at 6800. That point of control from 2 weeks ago, it's probably going to need more work, right? Go into the intraday and see how price reacted or responded around that level. 6881 or 6882 is an old school cog line we don't use anymore, but still 81, 82 is always a level I keep my eye on. But it would probably be interesting to see how price responded around that level. The problem is, if I'm remembering where that spot is correctly, that was after the close, right? It was before the 5 p.m. futures cutoff, so price was still moving from that day's session, and then Nvidia had its earnings and the ES jumped up that last little bit. And so that's not going to be the kind of liquidity that we want to see when we're evaluating a tag of a point of control. So as far as I'm concerned, long story short, that's still a level you want to keep marked out. We will eventually go back up there. I don't think we're done with that point of control. Now, to the downside, we've got that other point of control. We need a little more time here. Way back yonder, just a wee bit. $67.80. There we are with those 80s again, right? So if we do continue the breakdown and we get through 68.50, then we want to target that round number 6,800, and then we'll focus on that old point of control that I marked out down here. Now you can see we've already interacted with that level multiple times, but we haven't expanded below that level, and that's why I continue to keep it on the radar. $10-day, 30-minute volume profile and TPO. We got nothing here. It's a really narrow distribution until this latest pop to the upside, and there we didn't get much out of it, right? You can see that nicely in the TPO. So what we have overhead, I wouldn't focus on it at all, and we're just in this big lump of trash that we've been in forever. So GTFO, right? We got to get out of that box. We got a new VPOC from yesterday. I don't think we have any. Yeah, no, we don't have any. So VPOC just means volume profile point of control that we have not hit. And we can see that that's over our head right now. That's what we want to focus on today. Now, the textbooks will tell you to carry all of these three lines forward every single day. The value area high, the value area low, and the point of control. I don't do that. I've got enough pivots, but I will carry forward the point of control if we haven't hit it yet. And I'll carry it forward every day until we finally do hit it. So maybe it lasts 2 days, maybe it lasts 2 months. We are getting near the end of the contract for the ES, right? This is the March contract we're going to be swapping off in about 2 weeks. And there is an argument to be made that once we're on a new contract, the volume that created this profile will be off of a contract that nobody's even holding anymore. I used to make that argument myself, but I've moved past that. So I'm going to keep it on there even after the contract changes. It's 69.20-ish, so it's not one of the cog lines or anything like that. It kind of stands out because it's not one of those levels. I think it's worth keeping it on there. Of course, once we run up and hit it, then we're going to be done with it anyways. But until then, that's a level to keep on the radar. We have next week's range projected. This is not locked in yet. It's continuing to move. The gray line is current price, and the red and green lines are shifting, expanding, and contracting with the trades that are happening within the options market. So after the close today, this will lock in place and it'll be like all of these old ones. But throughout the day today, it's live, it's moving. What we want to focus on Fridays is what's the projection suggesting to us? Is next week a narrow week? Is it narrower than the week that we just had? Or is it a bigger week than the week that we just had? It seems counterintuitive, but if it's a narrow week, that does not imply that we don't have a big threat for next week. A narrow range would imply there's something on the calendar that the market is concerned with, and the market thinks we're going to go sideways into that event. For an example, FOMC. Events like that are volatility suppressing, and they will make our weekly projection narrow, which is a nice heads up that there's something on the horizon for next week that the market is concerned with. I just marked it out and set it on our current week's range, and you can see it's not a narrow range week. If it was, the box would be a lot smaller that I drew, and we'd be able to compare that against our current week, and it would stand out, right? Be like, wow, that's a really narrow box, but it's not. It's a larger box than the range that we had this week. So on the other side of that, the market is pricing in volatility for next week, and it's not connected to the economic calendar, because if it was, like I just explained, the range would be narrower. Whatever threat the market sees, they think it could cause an expansion bar, something like one of these big expansion bars, and it's not connected to the calendar. That could be the Iran war threat, right? Middle East threat. It could be something out of China. It could be anything else, right? Anything other than something off the economic calendar like FOMC, PPI, CPI, non-farm payrolls, one of those events. So whatever the threat is, the market is pricing in the possibility of a continuation, and maybe finally we get out of this range. Volatility is a fancy word for movement. Implied is another way to say promised. Put that together, promised movement, implied volatility. The market is pricing in the possibility or the promise or the probability of making big moves next week. There's no directional bias to that. It's not saying up or down, just that we could get these big gyrations, these big bars. One of the takeaways to that is that we're likely to see a breakout of yesterday's high or yesterday's low stick and run next week. A lot of times when we break the previous day's range, we get outside of it and we come back in again, right? That's why the 111 is so awesome. But that wide range implies that if we break the previous day's low, that maybe we just keep going, that we don't turn around and come back inside the box. But those are next week's worries. It's not set in stone. Like I said, we'll reevaluate it on Monday and see if the range narrowed up by the end of the day today. We are back below the 10-week, but just barely. And this is not negative. I wouldn't read this as being bearish in any way because we're basically at the 10-week. Unless or until we really expand below the 10-week, this minor little dip below is nothing. We're basically just on it at this point. So I wouldn't read this as being heavily negative, and the fact that we're underneath it a minor amount is nothing. Looking at the 10-day, same thing. We're just barely below it. I got an imaginary collar 0.5% above and 0.5% below the 10-day, and we're within that imaginary range. So there's nothing here. one of the things that I use this indicator for specifically is answering the question, have we moved too far, too fast, and does the market owe us a pullback? We don't even need this, right? Because we're in the same darn spot we've been in for 2 weeks, but still want to be able to answer the question, and the answer is no. We haven't moved too far, too fast. No, it doesn't owe us a pullback. It doesn't owe us anything. We're not bearish. We're not bullish. We're not broken. We're just sitting in this darn range that we need to get out of. Looking at what's down this morning, it's a very long list of things that are down at least 0.5%. The Mag 7 up volume is down. We've got industrials, uranium, growth ETFs, the mags, cloud computing, generic tech, generic finance, banks, chips, just everything, right? Everything. Bitcoin, everything is down this morning. Looking at what's up this morning, at least 0.5%, the Mag 7 down volume is up about 0.5%. And XOP, generic energy, nat gas. So that's about it, right? And of course, the VIX. The VIX is up 11% this morning. So we got nothing. If we want to see that turn around, we're going to need either some 0-day flows, some market breadth from the sectors, some move from commodities, FX markets. Something's got to give the ES and the NASDAQ that push to get outside of the range and really start going somewhere. All right, so just to recap, get everything nice and neat and organized. You got to get out of the box before you get anything else done. That's our Globex range. To the upside, challenge 95, which is the mid. Get back through the top, and then we'll work our way back up to yesterday's high. To even get to yesterday's high, we've got to get through yesterday's midpoint. So 69.20. That's a level we were just talking about with the intraday point of control, by the way, right? So that's going to be a difficult level to struggle with. Get past that, then we've got yesterday's high that we can fight against. But we have to get out of this box first. Otherwise, to the downside, we've got yesterday's 111 and yesterday's 1236. So there's the 111 at 59, and at 47 is the 1236. If it's a breakout reversal, meaning we get outside of yesterday's range and then we just flip it over and come back in again, that reversal is most likely to happen along the 111. Either before we get there, we just turn around and go back, or we get there and then we turn around and go back. So if the fake breakout happens, it's most likely to happen at 111. If we get to 1236, then we look for the OCC, opposite candle color, or doji, and then we continue to hunt for lower levels from there, right? So it really doesn't matter which direction we go today. We've got our levels. The path of least resistance is lower, by the way. But let's wrap up with this because we're running out of time. I started today's stream talking about maybe grabbing some lottos, taking a look at the weekly, looking at what we've got on the calendar, everything that's going on out there. SPY with 700 or 705, 710, some cheap calls, and I do mean cheap because there's no conviction for these, right? It's not like we have momentum, trend, inertia, anything that says long or short. So if you're buying puts or buying calls, I don't care which direction you want to go, you don't have any reason to be doing it, right? So keep it as cheap as possible. They're just lottery tickets. They're no different than going to the gas station and buying a scratch lotto. You think anybody's going to offer you $1 million just because you bought a $2 ticket with a high probability? No. It'd be a 1 in a million snowball's chance in hell that you buy a $2 ticket and win $1 million. That's why they call it a lottery, right? So same with these. Buy a 705 or a 710 call, buy a 650 or a 600 put. There's no high conviction, high probability trade there, right? It's just something really cheap because we're going to get out of this range at some point. If you can't find a cheap trade out of that, shop around. SMH probably has some pretty cheap options. SMH will respond the same way that the S&P and the NASDAQ does, very likely, right? It's what Spot Gamma likes to use frequently. So if you don't like the cost of the S&P or the NASDAQ options, find something cheaper. If the market is going to go down or going to go up, then it's going to be a rising tide or, a falling tide, and everything else is going to move with it. So just find something cheap enough that matches what you're willing to risk. I'm going to be looking for upside. I think 700, 705, 710, and the March options expiration, the OPEX, is what I'm probably going to use if I can find something with a risk that I like. That's what I got for you guys. Be careful, be safe, have a good weekend. I'll see y'all next week.